You've probably heard people talk about the importance of Roth conversions, and you may have even heard people talk about filling up certain key tax brackets. But what does that actually mean? What does that mean from a dollar amount in terms of how much you should convert from your traditional IRA to your Roth IRA? In today's video, we're going to talk through exactly that. What does it look like year by year with specific dollar amounts to actually implement an effective Roth conversion? To do so, we're going to look at a case study. This is Chris and Cindy. Chris and Cindy are both 65, and as you can see here, they've done well with their investing and their saving over time. Chris has an IRA worth about $1.2 million. Cindy has an IRA with just under $500,000 in it, and they have a joint account with $844,000. They have a paid-for home, and they have some money in the bank, and their goals are as follows. They want to retire right now. They want to be able to spend $6,500 per month in retirement. The income sources that they'll have in retirement is Chris's Social Security, which he will collect at age 70, and his benefit will be $3,900 per month, and Cindy's Social Security benefit, which she will collect at age 67, and her benefit amount will be $2,600 per month. So to summarize, they just retired. They're both 65. They want to spend $6,500 per month. We just looked at what their Social Security benefits will be. Now we want to take a look at, are they on track, or what will their retirement cash flows look like before turning this to the tax strategy, which is those conversion amounts. Here are their retirement cash flows. Cash flow is simply looking at what income sources do they have coming in compared to the expenses that they have to maintain their retirement lifestyle. If we start with income, we can look at this here. Social Security, but if we drill down into it, Social Security for Cindy starts at 67, and here's what that amount looks like every year going forward. Chris's benefit won't start until age 70, and here's what that benefit will be, increasing each year going forward. Total Social Security, you can see, is nothing for 2 years because neither are collecting. Then just Cindy's benefit, then the combination of their benefits. Now that's important because that's going to tie into the tax strategy that I'm going to show you in just a second. So keep that in mind. So that's their income. What we're comparing that to is their expenses. And to keep things simple, we're keeping all expenses combined here, $6,500 per month. You can see what that looks like per year, adjusted for inflation going forward. Tax payment, this is showing, before any Roth conversions, what would their tax liability be in terms of federal tax payments and state tax payments based upon where they're pulling money from their portfolio. They're going to start by pulling money from their taxable account. And in fact, because this is so low, because they have such a small tax liability, is why we're going to do a Roth conversion strategy. You can see here, what happens if they don't do any Roth conversions? When they turn 75, these will be the required minimum distributions. And you can see those required minimum distributions start at $150,000. And if they don't do anything, those are going to increase all the way up to $439,000 by the time that they turn 90. What does that mean for them? Well, it means their tax payment is going to jump from a few $1,000s, like it's projected to be in the first few years of retirement, to tens of thousands of dollars, and that will actually increase up to a six-figure tax liability if we don't do anything in terms of Roth conversions to help to mitigate that tax impact. So this is what we're looking at, and as we look at this, here's what their portfolio needs to do. Here's how much they need to pull from their portfolio to be able to maintain this. Right off the bat, what we can start to see is they're in a solid spot because once both of their Social Security payments kick in, they have enough income coming in from that to fully meet all of their living expense needs, which means there's really no requirement from their portfolio, no extra requirement. That's a separate planning point of they should be spending more, they could be spending more. We're going to address that at a different time. For right now, we're going to take a look at their tax strategy. So here's the tax strategy for them. This is as things currently stand. What this purple represents is this is their adjusted taxable income, not just this year, not just next year, but projected out every single year until age 90. What you can see is their taxable income is expected to be pretty low for the first several years. That makes sense. We just looked at their cash flows where they're not going to pay more than a few $1,000s in taxes for the first few years until age 75 hits, and they have a huge jump in their tax bracket. Now it's incomplete if all we look at is their taxable income. We need to compare that to what tax bracket will they be in. So what we're going to do is we're going to overlay the various tax brackets here of where does the 10% tax bracket start or end here? What about the 12% bracket? What about 22%, 24%, so on and so forth? And what we can then do is say, where are they today, not just in terms of taxable income, but where are they at in terms of various tax brackets? And we can compare that to what tax brackets are they going to be in the future. So here's why this is so important. We can see that today they're projected to be under the 10% bracket, whereas in the future they're projected to be above the 28% tax bracket. So what can we do with this? What we're going to do with this is we're going to help to quantify what amount, what's the dollar amount they should be converting to fill up each of these brackets here. So for example, to start, what if they just filled up the 10% bracket every year? So in any year where their taxable income was underneath the 10% bracket, convert just enough from traditional IRAs to their Roth IRAs to fill up that 10% bracket. In doing so, that would lead to a $150,000 increase in their tax-adjusted ending portfolio balance compared to the base case plan. We could then see how does this compare if we fill up the 12% bracket or the 22% bracket. Now, I've already ahead of time looked at this, and the 22% bracket is what's going to make most sense for them today. So if we click refresh here, what you can see is this strategy adds almost $470,000 of tax-adjusted ending assets to their plan. So that's solid. Now, by the way, subscribe to this channel if you haven't done so already. Every single week we're doing case studies, we're releasing videos that help you create a more secure retirement by showing various strategies like we're looking at today. So make sure that you subscribe. As we're looking at this, the goal of this video isn't just to say fill up the 22% tax bracket and stop. Now, for everyone, it's going to be different based upon your plan. For Chris and Cindy here specifically, for them, it's going to make most sense to fill up the 22% bracket. But what we want to see is what does that represent as an actual dollar amount? Well, if we want to see the specific dollar amount, we go from this page. And this page, by the way, is looking at a 30,000 foot view. What brackets should we be filling up along the way to maximize our tax savings to this page? This details page shows you what the specific conversion amount should be year after year. And what you can see is that amount actually declines. The reason this is declining is in these first few years, there's no Social Security coming in. There's no Social Security coming in, which means the taxable income is lower, so you can convert more before exceeding that 22% threshold. Once Cindy's Social Security kicks in at age 67, you can see there's a corresponding decrease to the conversion amount. Now, it's not an exact dollar for dollar decrease because of the way Social Security is taxed, and not all of Social Security is included in your taxable income, but there is a drop. Then at 70, there's another drop because Chris's Social Security gets turned on. And so as other income sources increase, you would convert less to still fill up that same 22% tax bracket. Now, if you want to run these projections on your own and get a sense for how much you might be converting or should be converting, you can get access to this software. It doesn't come with advisor access, but you can get access to this software using the link below for the Retirement Planning Academy. So you can walk through this on your own, plug in your own numbers, and see what conversion amount might be most effective for you. But here's what I want to point out here. This conversion amount, you can see this dollar amount changes year by year. So when someone says fill up the 22% tax bracket each year, or fill up the 12% tax bracket each year, whatever the tax bracket is, that doesn't mean that you should be converting the same exact dollar amount each year. The reason for that, if we run through a tax estimate here and look at the actual details, you can see that year by year, your taxable interest, your ordinary dividends, your other income sources, that's going to change. What does Social Security look like? What does dividends look like? What does interest look like? Do you have income from other sources? As that happens, it's going to change the amount that you should be converting from your IRA to your Roth IRA in order to fill up that same bracket. Here's the final thing that I want to share with you. When you do Roth conversions, expect it to hurt. What you are doing is you are front loading, you're prepaying in some sense taxes today, ideally at lower rates, instead of waiting until a future date to pay more in taxes because you're in a higher bracket or at higher rates. But to give you a sense of what that looks like, here's Chris and Cindy's projected tax bill. So federal taxes paid if they didn't do anything. You can see here they're projected to pay very little for the first several years, and then they're projected to pay a lot. By age 90, they're expected to have a $222,000 federal tax bill under these assumptions. Under the new strategy, under the Roth conversion strategy, they're paying a heck of a lot more in taxes up front. Yes, the software is accounting for the opportunity cost here. Of these are dollars that no longer can grow for you, so there's an opportunity cost to paying taxes. But what I want to point out here is you can see here that you're paying tens of thousands of dollars in taxes up front so that you don't end up paying an even greater amount in the future. But because these tax burdens in many cases are so large, one of the first things that I actually do is I look for good reasons not to do a Roth conversion. Roth conversions are not cheap, and sometimes there's other strategies that you should be prioritizing, or in some cases, Roth conversions don't actually help you. So that's why I like to start by understanding, is there a good reason not to do a Roth conversion? But the framework that everyone should follow, the process that everyone should go through, is take a look at 30,000 foot view. What might you save in total tax-adjusted ending portfolio assets through implementing a Roth conversion strategy? Look at that big picture, then narrow that down. Year by year, what does that mean in terms of the specific dollar amounts you should convert from IRAs to Roth IRAs? And then from there, you can execute that strategy knowing that that strategy is going to help you in the long run, even if it doesn't feel so good in the short run. Now, if you're wondering what are those reasons why maybe shouldn't you do a Roth conversion, take a look at this video right here. I walk through some of the key reasons you shouldn't implement a Roth conversion and when it might actually hurt you more than it actually helps you. Root Financial has not provided any compensation for and has not influenced the content of any testimonials and endorsements shown. Any testimonials and endorsements shown have been invited, have been shared with each individual's permission, and are not necessarily representative of the experience of other clients. To our knowledge, no other conflicts of interest exist regarding these testimonials and endorsements. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.